Hello everyone, and welcome back to Dr. Tao's Quant Lab. Up to this point in the course, we have been intensely focused on individual stock analysis, how to value them, when to buy them, and when to sell them. But you constantly hear financial media say, the market is up today or the market is crashing. What exactly is the market? Before we can build a macro level quantitative strategy, we need to define the foundational components of the US financial system. Today, we are breaking down the four major US equity indices, how they are weighted, their hidden risks, and the exact ETFs we use to trade them. Let's start with the gold standard, the S&P 500. Compiled by Standard & Poor's, this index tracks the 500 largest, most financially viable companies in the US. It is market capitalization weighted, meaning the larger the company, the more influence it has on the index movement. Because of massive market growth, S&P recently updated their cutoffs. To even be considered for the S&P 500 large cap index today, a company must have a market cap strictly over $22.7 billion. The top 100 companies are well over $100 million, $1 billion, and the median sits around $37 billion. Because it represents over $60 trillion in value across all sectors, it is considered a highly stable, medium to long-term benchmark. If you want to trade or invest in the S&P 500, the most popular representative ETF is SPY. Keep in mind, this index rebalances quarterly, which can cause localized volume spikes. Next, we have the Nasdaq. Well, the Nasdaq composite includes almost everything on the exchange. Quantitative traders focus on the Nasdaq 100. This index tracks the 100 largest non-financial companies listed on the Nasdaq. By explicitly excluding banks, it removes financial sector volatility. But it heavily concentrates the index into information technology and biotech. If you are bullish on tech, this is your vehicle. We trade it using the QQQ ETF. Just remember, with higher growth comes higher volatility. When the tech sector catches a cold, the Nasdaq gets pneumonia. Third is the Dow Jones Industrial Average, or the DJIA. This is the index your grandparents probably tracked. It is composed of just 30 blue-chip, industry-leading companies. But here is the critical difference. Unlike the S&P and Nasdaq, the Dow is price-weighted. This means a stock with a $500 share price moves the index much more than a stock with a $50 share price, regardless of which company is actually larger. Furthermore, while it includes giants like Apple and Nvidia, it entirely excludes Google, Meta, and Tesla. If you buy the Dow using the DIA ETF, you are completely missing out on the price action of three of the biggest tech giants in the world. A small 30 stock limit also exposes you to heavy idiosyncratic risk, meaning that if one high-priced stock collapses, it drags the whole index down. Finally, we have the Russell indices, which tracks the broader US market. The Russell 3000 tracks the top 3,000 companies. The top 1,000 of those make up the Russell 1000. Now, institutional funds use the Russell 1000, but active traders completely ignored it because its chart looks visually identical to the S&P 500. We prefer the S&P 500 because its ETF options liquidity is vastly superior. So, when a trader says, I'm trading the Russell, they mean the Russell 2000. This tracks the smallest 2,000 companies in that 3,000 list. The median market cap here is roughly $1 billion. These small caps offer massive growth potential, but they are highly vulnerable to capital shocks and bankruptcy. You trade the Russell 2000, use the IWM ETF, and it is highly suitable for speculative right-side trading during confirmed bull markets. But in a bear market, you stay far away. Also, mark your calendars. The Russell reconstitutes annually every June. That day is consistently one of the highest volume trading days of the entire year, as institutions practically buy and sell to match the new index. Before we wrap up, a quick practical tip. If you want to see exactly which companies are in these indexes today, don't dig through the official S&P or FTSE websites. Just look up the holdings of their ETFs, search SPY ETF holdings State Street or QQQ ETF holdings Invesco online, and you will get a free, perfectly weighted, real-time list of the market. Now that we know what the market is, we need to talk about the companies carrying it on their backs. In our next lecture, we are going to dive into index concentration and the Magnificent Seven. See you in the Quant Lab.